Okay, so today's event is called Understanding Debit and Credit Spreads. I'm also traveling along with Tony, so we've both been kind of struggling with this. But with that said, we have a seminar that is going to be based off of a PowerPoint today. And then we're also going to run into the Options Play platform and show how to set up debit and credit spreads. So we're going to start with the very basics of what is a debit and credit spread, otherwise known as a vertical spread. And then we're going to actually pull up the Options Play platform and show how you might find these trades. So before we get too far along, there is a disclaimer. Our disclaimer here is that if we're going to be showing some real examples, and that's not meant to be a recommendation. We don't know exactly what your portfolio looks like. So if you do see real examples, they're not meant to be a recommendation. And past performance is not always a guarantee of future results. So our agenda today is to introduce vertical spreads, otherwise known as debit spreads. There's many different names for this. They also call them bull call spreads, bear put spreads, and we'll go through some of those examples and outcomes. And then we're going to go in and answer any questions that you might have. During the event, I don't take a lot of questions, but when we get to the end, if you load up that Q&A box, we will address the questions at the end of the event. And then please try to use the Q&A box. The chat box is available if you'd like, and you can chat amongst yourselves, but the Q&A box is what I'm going to be focusing on. All right, how can I minimize risk and maximize profits by leveraging multi-leg option strategies? And here's one of the biggest things. I've been teaching options for about 30 years, and one of my most popular white papers that I've ever written are the top 10 mistakes of beginning option traders. And I highlight that on this slide mainly because a lot of people are scared to get into multi-leg option trades. They just want to buy a long call because they think the market is going to go up, or buy a long put because they think the market is going to go down. The problem with single leg option strategies is you either, well, if you're buying them, you're battling time decay. You're battling a lot of the nuances of trading options in general. And if you are open-minded, willing to look at spreads, well, that can help battle that hardest thing to deal with in option trading, which is time decay overall. What do we do with this little thing that's called time value inside an options price? And we'll get into that a little heavier. So that is one part of my top 10 mistakes white paper that I put together to try to highlight what beginning option traders usually, some of the mistakes that they'll make. And the biggest one to me, one of the biggest ones, is just not being willing to explore a little bit more advanced option strategies. So here's a simple strategy, and today we're going to start by doing a bear put spread in Marriott International, the hotel chain. MAR is the symbol. But first of all, we want, if you're looking at the chain, you have a limited risk strategy to take a directional view on the marketplace. So we're going to say limited risk as opposed to just buying a put outright. If I buy a put outright, I'm going to be paying the premium for that put option, and that is going to be my max risk. When we said we're going to limit the risk by selling an additional option contract, we're going to actually lower that risk, and it's going to be limited to the net debit that you paid for that trade. It's suitable for either mild or large directional bullish and bearish outlooks. We're going to start bearish today, and typically provides better liquidity due to limited risk. Well, here's the thing is, when we're executing the trade, the market makers like that you give them a buy and you give them a sell. And a lot of times in the options trading world, trying to execute trades, there's some benefit to entering the trade as an actual spread. And we'll get into a little bit more detail on that as we look at a real example. All right, so we're going to leverage your capital on stocks. Also, you can do this on ETFs. that you have a strong directional view on. And I'll talk about a few of the views that we've done recently in the marketplace. We're going to look at it. I'm going to actually share with you a daily play that I put together last night for this morning. This provides leverage and a strong risk reward, but requires paying time decay. Well, yes, and we can deal with the time decay issue by setting up the spreads. Okay, so we have limited risk and limited reward. Now, that's the downside, is that if you remove some of this risk by lowering the net debit as opposed to just buying the option outright, that also means you got to give up some upside. And that's always the case with options. If you reduce risk, you usually reduce your upside. And that is just always the trade-off. So then you have to decide, is this trade-off worth it? Okay. So here's our bearish debit spread that we put together on Marriott. This is actually the options play platform. And this is a screenshot. This was I guess over a year ago at this point in time where this example was put together. And what we were doing is buying a debit vertical spread. Now, that's kind of a fancy name, and I always like to try to define why it's called a vertical spread, because I do think that helps. Now, I've worked on the Chicago Board Option Exchange for many years, and if you walk down to the floor and you look up at the quote boards, you will see that it looks almost like any other brokerage firm, like a normal vertical board that has quotes on it. So hence the name vertical spread. It means that if a market maker is sitting or standing in a trading pit, which used to be a much more common, well, when the Chicago Board Option Exchange was the only exchange out there trading them, trading listed option contracts, you would stand in the pit and you would look up at the quote boards, and you would have to look vertically in order to set up a spread. You would have one quote that had a strike price that was higher, and then you'd look at another quote at another option contract that had a strike price that was lower. And that's how they were quoted on the boards, and hence they came up with the name a vertical spread. So in this scenario, if we buy the 200 put, and we pay $7.75 for it, and then we sell the 180 put, we receive $2.38 for it. So this was real prices on this day, this screenshot set up inside the options play platform. So we are going vertically on the quote boards, and in the put world, the 200 strike, which is where the stock is currently at, trades for more than the 180. The strike price is above, and you want the market to go down. So you have the right to sell, to put stock to somebody at 200, and you have the obligation to buy it at 180. That's the way the long put spread or the put vertical spread is set up. Now, whenever you're entering this trade, I very, very rarely, I should almost say never, enter a spread and say I want to buy it at the current market price. So if I'm entering this order, I'm looking to enter it at what's called the net debit, and I pick that price and I send that to the trading floor. I want to say that if it's trading for $5.37 or better, then you can fill my trade. And what that is, that's the difference between 775 minus 238 is $5.37. And when you do that, that means that those prices have to line up in order for this trade to get executed. So here is our put vertical debit spread with the stock trading right now at 200. Our example is we're going to be buying the 200 strike put, paying $7.75 for it, and selling the 180 strike put, paying $2.38 for it. The expiration date here, it says, is May 17th, 2024. But what's important inside the options play platform is that 64 days away, mainly because this example was set up a little bit earlier. Okay. So here are the outcomes. If we put this trade on and the stock is below 180, that means our forecast was correct. The stock came from all the way up here, trading at 200, all the way down to the 180 strike. That would be our full profit. And the way that we'd figure out the full profit is we do the difference between the strikes minus that net debit paid. Now, in our example, we're talking about one option contract. So the vernacular that I like to use, this would be our full profit for every 1-by-1 spread that we are putting on. We are sending it to the trading floor as one trade, and we're paying a net debit for that trade. So if we jump back here 1 second here, our net debit is $5.37. So the math is simple in that you take $20 minus the difference between the strikes, 200 to 180, minus that net debit paid of $5.83, and then you will multiply that by 100. So 20 minus $5.37 is $14.63. You multiply that by 100, and you get to the max profit for every 1-by-1 spread that you would execute of $1,463. So if we're below, that's our max profit on our spread. If we are between the strike prices, if we are below 92.50 and 104, 101.41, then we make that full profit, basically the whole way down. And we have this same profit between 180 and 194.63 on our chart. So if we do land somewhere in the middle between 180 and 194.63, between our inside our strike prices, below our break even and above our short strike, well, then it depends on where the underlying stock is at. This is where the hardest scenario happens. If you get to expiration and the stock is trading between your strike prices, because then you need to decide, well, where do I want to get in and where do I want to get out of the trade? So it's not a home run. You didn't put the trade on and the stock ran down to 180 where you could make the full profit. But now the stock is at expiration, it's gone down and it's trading between where our break even point is at, which is 200 minus the $5.37 or 194.63, and the 180, which is the short strike of our long put spread. So if we're right at 194.63, and that's exactly where the stock stops at, well, that's our break even. That means that we made zero on that trade. And if it goes all the way down towards the 180 price, we anywhere the further and further that it goes down, there is more profit that can be made on that position. So here are the outcomes. The full profit, if we go below 180, is $1,463 per 1-by-1 spread that we put on. We could have some profit if it's between these strike prices, between 180 and 195. And there could be some loss between 193 and 200 on this trade. So depending on where we're at in the expiration cycle, that would be our loss. Now on the upside, this is quite simple. Just like below 180, the profit is straightforward. Our loss is our net debit paid if the marketplace goes above 200 and hangs out at that level, that max loss would, per 1-by-1 spread, would be $537. All right, so if we're doing a spread, much like if we're doing an individual option contract, we want to have a plan and we want to work that plan. So if we buy a put outright, very rarely do people just buy a put option and say either the market goes down and I make money, or the market goes up and I lose everything that I paid for. So the attitude usually is, if the put gets to a certain price, I'm going to get out of the trade. And a lot of people think of it that way when they're trading stocks too, that if the stock goes down to a certain level, I'm going to exit this. Would be called a stop order as far as the stock is concerned. So in this instance, if I am doing this trade and I put the trade on, I want to exit the position if I lose 50% of the premium that I paid for this trade. So if we put this on for $5.37, if you multiply that by 0.5, or you cut it in half, you divide it by 2, that means that our stop loss, where we'd want to get out, is if we saw this spread trading for a net credit of $2.69. If 50% of the premium comes off, I want to get out of the trade on the upside. Now, the max profit on the other side of the coin, if the stock goes up, we want to exit half of the position with a 75 to 100% of the premium paid. Keep half on for potential max profits. So if we do put the trade on for $5.37 and the width of the spread is $20, right? Between 200 to 180. We still want to take our max profit if we ever, or at least half of the position, if the market gets to $10.75. So in our scenario, we talked about a 1-by-1 spread that was put on. We'll usually look at inside the options play platform, whenever we put together a recommended trade that we're doing that we call daily plays, we will say that you want to use 2% of your speculation portfolio to, if you have that luxury, to actually get into any trades that you might want to do. So once I put that trade on, if I have more than one contract, I'm going to adjust my spread differently. But if I have only one contract on, and we just talk about this on a 1-by-1 spread basis, we're going to say that if the market gets up to 1075, if we double our price here, we're going to take the profit. So if it's on a 1-by-1 trade, we're just going to sell that trade and we're going to get $10.75. If the market comes down and we cut this net debit paid in half, we're going to also take half of our loss. So what we're doing here is we're setting up a scenario where we let our profits run and we cut our losses short, right? So we want to make at least 100%. Our goal would be to make 100% profit on the upside if we're correct on our forecast. But if we are incorrect, we're going to stop that loss, which is right here. And we actually have stop losses inside the options play platform at 50% of the net debit that was paid for the trade. So here inside the bullet point inside the slide, it says we're going to take off half of that position. Well, if I have a 1-by-1 on, that's going to be 100% of the position. If I have two contracts on, if we get to this and we get this type of credit, then we're going to sell one of the spreads and then let the other one run to see if we can get to max profit on the trade. And if we did that and the market started coming back down on the trade and we didn't get to the max profit, I still want to be able to get out at least what I paid for it. So I don't want it to come all the way back down to the stop loss and exit that trade. So That's the way that I would approach it if I have larger than one contract on in my position. One second. All right, so now that I've gone through the first example, let me go and pull up the Q&A and see where we are at. I'm working from one screen today because I am traveling also. So in your examples, the diesel asks, when you mention the risk or reward on a trade, is this based on a per contract 100 shares basis? Want to be certain about the potential. Yes, it is. It is. Well, I think Diesel, I walked through that. You have a one by one trade that you put on. And if you have that trade on, you that net debit that we paid for our trade was $5.37. If it's one contract, you multiply that by 100. So our example that we went through when we talked about the different scenarios on the loss, that was on a per contract basis of one contract. How does someone repair a vertical trade? Well, that's a much deeper question, Diesel. If I'm looking at a vertical trade and I want to repair it, some of the ways that you can do that is you can roll it into different strategies. Um, yeah, I don't. It's a little above and beyond what we're doing right now. And then we will email you a copy of the PowerPoint slides when we are all said and done with the event. All right, so let's go back. So back to the PowerPoint. Now let's go in and look at the credit spread example that we have. And in this instance, we're going to look at Starbucks, and we're going to do the exact same thing. Now, in general, if I'm doing a put vertical spread that I pay a debit for, I usually have more reward than overall risk, right? In that we put that trade on for $5.37, but our upside was $14.63. This will be the opposite in that we're going to have a higher probability of success, but as usual, when you set up a credit spread example or any other type of trades, you have a higher probability of success, but then that changes your risk reward. You're going to have less reward and more risk. So let's go through that example and show why. So in here, if we sell a credit spread, once again, we got the same expiration. Well, it's the May 17th, but we have 43 days to expiration. Pointing to it over here, you got to maybe have to squint to be able to see that, but there's 43 days to do it. We are going to sell the 97 strike call. So in this instance, the underlying stock is at 96. We're going to sell an out of the money call. We're still going to be bearish on this. It's a credit spread, by the way. I'm sorry, it's a bearish credit spread. So if I'm selling the 97 strike call, I can bring in $2.77 for that. I go further out of the money and I buy the 102 strike call. I pay $1 or I pay 77 cents for it. We bring in a total net credit of $2 in this situation. So if you think about rights and obligations, if I sell this 97 strike call, I'm saying you can call stock away from me at 97. And I may have that stock taken from me at $97. Right now it's trading at 96.93. So it's just a little bit out of the money. Now, if that did happen though, and the stock runs up to 105, I say, oh, hey, wait a minute. You can call it away from me, but I have the right to call it away from someone else at 102. So I have the right to call it at 102, but I have the obligation to give it up at 97. That's 5 points. This means I have 5 points worth of risk. I have to buy it at a higher price than I have an obligation to sell the underlying stock at. Trying to say it many different ways. Bringing in a net credit of $2 to the account. That means for every one by one spread that we do, we're going to bring in $200 on that trade. So here's our outcomes. If the stock is below 97, so we got the trade right here and we say the stock goes down this direction, we're going to make that $200 profit. So in that instance, that is our max gain. We can't make any more than that. And the way that I kind of like to think about credit spreads when I'm putting the trade together is it's just like selling anything. You sold your car to somebody else, and let's say you sold that car for $2,000 or something, just to try to make the example fairly close. And nobody's going to go and drive that car around for a month and then come back and say, you know what, this is a really good car. I think I should give you $2,500 for it instead of 2,000. And see, that just doesn't happen. When you sell something, you get money now. That money that you get is the most that you're going to make on that trade. And that's the way I like to think of credit spreads. If I sell this and bring in this net credit, I'm going to get what I sold it for. And in this instance, on a one-by-one basis, it would be $200. That's the maximum I'm going to get. And I'm going to get it now. I get it up front. I get it as soon as I sell the trade. But that is the maximum that I can make on that trade. Now, if stock is between 97 and 99, once again, you're talking about going back to our example here, our break-even point and our pain point on the trade, which is $97 is what we want the stock to stay below, and then $99 is what we want the stock to not go above. So we'll have some profit if we stay within this range, and this is where the chart is kind of showing it here over here on this side. Now, that's where the hardest scenario is. Where do I want to take the profit? And we'll go through a few of those examples once again, just like we did on the debit spread. Now, if the market is between 99 and 102, there could be some loss on the trade. So now we're up in this range on the chart. And if we get above 99, that's where things get scary, right? Because that's where our break even is at based off of the net credit that we brought into the account. So if the market does go above our protection, our strike that allows us to buy the stock at that price, well, if we're starting to approach that, well, there's a potential for some loss on the trade. And then lastly, if the stock is above 102, our maximum loss is going to be the $3, which is the width of the spread, 5 points, minus the net credit received, 2 points, or $200, 500 minus 200, which is our max loss of 300 on the trade. Okay, so here's our rules that go along with that. We're going to define our exit strategy, and it's going to be the same thing too. Once again, if you're talking about if you have just one trade on versus more than one by one spread, we're going to exit the full position at 100% of the max gain. So what was our max gain on this trade? Our max gain was $2. If the market just went straight south in this scenario, the most that we could make is that net credit received, or $2 on this trade. If the market goes up and we see, oh my gosh, it's going against us, we would have to buy to close the strategy. We would be buying to close the short option, selling to close the long option. If that gets double the max gain, we don't ever want to lose more than what we could have made on the trade. We're going to pay that net debit and we're going to get out at $4. All right. So in this instance, if we put this on and we can, and we see ourselves losing, we have a higher probability of success, but we don't want to lose more than the maximum on our trade in this instance. Now, the highest that it could trade for, as we mentioned, we could lose $3 on the trade. It could be trading for $5 total, but we don't want that scenario to happen. And if that was the case, we'd be losing $3 on each and every one by one spread that we put on. Now, we're going to exit the trade with a 50% gain, keeping half of the potential max profit. So if we put it on for a net credit of $2 and we can take it off and pay a net debit of $1 on our trade, that's going to be the goal. We're going to look to take at least 50% of the trade. This example was a little tight. Normally, we're selling an at-the-money option contract, usually a little bit further out of the money when you set it up. And I'll look at an example like that here shortly. But where it's a little bit more, I think, in my mind, feasible the way that I'm going to enter the trade. But if I can get half of it, I want to take at least half of the position off. And then if the market continues on down, my biggest thing about credit spreads is it's usually not worth trying to grab the last nickel or dime off of the trade. Now, if you put the position on and the market goes the direction that you want to, in this instance, we want the market to go down. And I can see this thing trading. We put it on for a net credit of $2, and I see this trading for a net debit of a nickel or a dime. I'm more than likely going to just take the trade off, because trying to get that last little tidbit is usually not worth the risk, especially with short spreads, because if they go against you, they hurt real quickly because you have a lower net maximum profit versus the loss. So if I have, especially on short credit spreads, if I have the ability to remove risk by paying a nickel or a dime, I'm going to do that to try to take off the trade. So in this instance, we're talking about taking it off. If it's $1, letting the position go. So we take off half of that position. And then if the market comes down and I can take off the remaining risk and pay a nickel or a dime on the trade, I'm going to do that on my credit spread management. All right, so before I get into the cheat sheet, let me go and see if I have any more questions that I can answer here. 1 second. Okay, so on the Q&A, all right, no, I thought we had a couple of other ones. Nope. No other questions. If you have any questions, right now would be the time to ask them. I'm going to go through the cheat sheet per se, just basically how we want to set up our trades and our profit and loss, where we want to take our positions at. And after I do that, we're going to run into the options play platform. We're going to set it up. So if you want to load up that Q&A box, feel free to do it at this point in time, and I will try to address any questions that you may have. Okay, so here's our cheat sheet. If I'm doing a debit spread, I'm looking for, well, it's something that I am more bearish or bullish on if I'm doing the debit spread outright. So my outlook is strong in one direction, and I'm looking at it as an alternative. If I was thinking about buying a long put in our example, consider a debit spread. If I was thinking about buying a long call, consider a debit spread as an alternative to just buying that option outright. So we're going to use spreads when you believe there will be a large and fast move to overcome the premium paid. Earnings or major break-even events, support resistance. If we see a breakout to the upside, this would be a strategy that we'd want to do. If we're trying to trade around earnings, a lot of times I want to put on a debit spread because there's a lot of things that happen to option prices around earnings. And it helps if you're buying one option contract and selling one option contract. So debit spreads are a great time if you want to try to take a position on earnings around a big event, around a big speculation event. So lower probability of success, usually with a strong risk reward. So for example, in our trade, When we initially put on the trade, we paid $5.37. That left a 20-point wide spread. 20 minus 530 was $14.63. So we had a lot more upside potential than we did on the downside potential. And so I want to be pretty bearish or bullish. My forecast, it needs to be a strong reason why I want to do that trade. Now, on credit spreads, these are something that you can just do weekly if you would like, in that I find a decent underlying that I want to trade. I expect a slower and mild trend. Biggest things about credit spreads is if I'm looking at a trade, I could say I'm neutral to bearish or neutral to bullish, because usually if the stock just stays where it's at, you're going to be profitable on that trade. And time decay is your friend. As opposed to when you're buying option contracts and paying a debit, time decay is usually not your friend. So in this instance, time decay is your friend. You use when you have a general trend without a catalyst. I don't like doing credits. A lot of people will go and say there's an earnings report, so I want to sell a credit spread because the option prices have increased because of the known event. Implied volatility has increased on that option contract. I don't like doing that because the risk reward is different. I would rather take a position and do a debit spread than a credit spread. That's just a great example of the difference between the two strategies. Mainly because that earnings report, that volatility is risk. There's risk in that news event. And I would rather get rewarded, if I'm correct on the risk, by having a scenario where I put up a third of the maximum gain, and if it goes up or down or whatever my direction is, that I can profit triple what I paid for it, as opposed to the opposite where I put it on and I got a minimum that I can make with the credit spread. But if it goes hard against me, I can lose more than I could potentially make. And so that's just a great example of how I'd want to address that. Okay, it's a forgiving strategy with higher probability of success, but has a negative risk reward ratio. And hence, I think the great example when you're looking at these two different things is to talk about the what you would do around earnings, right? Recently, and I'm going to look at this inside the options play platform, set up a daily play on Amazon around their earnings. They announced on a Thursday, used option contracts that had 1 day to live, and bought a long call spread to do the trade. And we're going to look at Amazon here in just a second. So when I did that trade and I set that up as a speculative, very speculative play around earnings, I chose to do the long call spread and not sell a credit spread to get bullish, because I wanted a solid risk reward ratio when I put on that trade, and that I wanted to make more on the trade than I risked up front. So that was a great example of when to use a debit spread as opposed to selling a credit spread on that position. All right. I see a couple of questions popping up, and I'm going to address those. I don't know why I can't get them to pop up, but I have to always stop sharing in order to do that. So here we go. Let me try to address some of the questions that we have right now. Is the SPX index in options play? No, right now the options play does not support that index, but it does support the ETF. So if you're interested in the SPX, the alternative would be the SPY. Okay, so then anonymous attendee is saying, from a strategy perspective, why not limit your max loss? This is a great question. Why not limit your max loss to 50% of the credit received as opposed to 100%? In the last credit example, when the $2 net debit premium was received, net debit was received, it mentioned to exit the trade at 4, and that would be 100%. If I'm risk adverse, there would be a benefit to exit the trade at a $2 premium loss. That way you lose nothing out of pocket if the trade goes against you. If you don't, here's the biggest thing about credit spreads, and I don't mind that comment about why wouldn't you want to receive 50%. So in our example, we brought in a net credit of $2 to the account. Anonymous attendee is saying, why wouldn't you close it out at $3 as opposed to letting it run to $4? And biggest reason why is you have a high probability of success usually when you're putting together a credit spread. And if you don't let it run and you don't give it some time to work for you, you'd be getting out of the trade too quickly, in my opinion. Most of the time, you're going to have success. You have a high probability of success on the trade. So if you're always closing out once you're down 50% on that trade, for example, this was done for a net credit of $2 to the account. What if you put a trade on that you received 75 cents for, or that you received even $1? Now you're getting out at a 50-cent movement against yourself. And I think that is actually a little bit more feasible. As I mentioned in this example, these slides that I'm working with, you're selling an at-the-money spread. Usually you're a little bit further out of the money, which means you bring in a little bit less premium. And so in my opinion, and just by doing the math on these, I like to close it out if you get 100% premium loss because the odds are against you or are with you in this situation. And that's just the way that I would prefer to trade it. I don't mind getting out at a 50% loss, but it's really hard to do credit spreads. You'll find that you're going to be getting out a lot too quickly, in my opinion. Okay. What do you mean strong risk reward ratio versus negative risk reward ratio? Luis, if I'm looking at that straight, that's a great example. Okay, so what do you mean by strong risk reward ratio? I think I answered that when I talked about doing the Amazon trade around earnings. In our example, if I have Amazon's announcing earnings, and I know that there's potential for it to, move immensely or move minimally. Like, in other words, it's not really too often that you have somebody announce earnings and it just kind of moves, right? Either it's going to move in one direction and it's going to move pretty hard in that direction. So if I'm doing that trade, I want a positive risk reward ratio. And in our example where we did our long put spread, we paid $5. Well, I'll just round it off. We'll say we paid $5 and our max potential was 15. That's the scenario I want when I'm doing a trade around earnings, like Amazon when they announced earnings not that long ago, because I just want more upside than I have downside risk. And in options, what's wonderful is that I can manage that risk. So when we're looking at the opposite side, when you're doing a credit spread, the odds of making the maximum on that trade are higher. But if the market goes against you, right, you have a higher chance of success on the trade. But if it goes against you, it's going to hurt a lot more than if you put on the credit spread. So you're bringing in, you have a very minimal maximum risk or maximum upside that you can make. And if the worst case scenario happens, it could really hurt you on that trade. So example, with Amazon, it did better. It moved quite a bit more than anticipated, and it had a strong earnings and strong upside. So if I was in the short credit spread saying that the underlying stock would not reach my strike price, well, that would have hurt a lot in that trade. Whereas the debit spread actually helped us out quite a bit and did well. Okay, would it be a good idea to enter a debit spread with both options deeper in the money to increase the chance of both options in the money at expiration to get the maximum? Well, Stephen, if you do that, yes, it's not a bad idea. And I like where you're going with this, with your question in that. Stephen's saying, why don't we just do deeper in the money options and increase the probability of it staying in the money on expiration? And the answer is, yeah, you can do that, but the risk reward is going to reflect it. So if you go deeper in the money, you're going to pay more for that long spread, and you're going to have the potential to make less on that trade. So it's all about risk reward. If you decide to do that and you buy an in the money option contract, our example, we bought an at the money, but you buy an in the money, you're going to pay more for the in the money than the at the money. And so you're going to have more overall risk up front. And that overall cost is going to help your overall upside. So most people that do it, they do it around the stock price a lot of times. And I can actually work through an example. Can you calculate implied volatility? Not in this seminar. It's above and beyond anonymous. I apologize. And got it. All right, excellent. So we got through those questions. So let's do a real example. Okay. So I'm going to go back to the screen. There we go. Oh, I didn't want to do that actually, now that I think about it. I want to go to options play. And right now, I just want to make sure you are seeing the options play platform, right? Okay. So if I pull up options play, and this literally just happened today, and this is part of the reason why I wanted to bring this up, because as I mentioned many times, I wasn't joking when I said that we did a trade as part of the daily play that was a very speculative trade with 1 day remaining. We did a long call spread in Amazon. And as I said, this is not meant to be a recommendation. Nothing is in this little scenario where we don't really know who's the person that we're talking to in your portfolio. We got to make sure that it fits your strategy in general. But that was a speculative play. It did work out. They don't always work out. Past performance isn't a guarantee of future results. But if I'm putting that trade together and did it on earnings, basically you're using out of the money option contracts because you think the stock can get there. Why? Because they're announcing earnings. That's what volatility does for you. Now, if you read my investment rationale that I put together last night on Amazon, we're having featured a speculative position before earnings. We're now considering a longer term trade as the holiday season approaches. So there's some rationale that's behind it. But in this trade, using the options play platform, there's a suggestion to buy a just in the money, it gets a 106 score in the options play, buy a just in the money option contract and then sell an out of the money. We're going to pay a little bit more for that because we're buying a little bit of an in the money option contract, but we're giving ourselves a lot of upside because we're selling a way out of the money contract. And we're going to do that to get us through the holiday season. It's just a total view on the actual fundamentals of Amazon as opposed to what might happen during earnings or the underlying stock just broke out above a support level to the upside. So we're going to do this long call spread or call vertical spread. Okay. So quite simply, type in the Amazon symbol and it says here, so even, yeah, this actually just, I don't want to hit refresh. I'm scared what might happen. I'm working with one screen here today because I am traveling. I'm still on my way back. So in this instance, here's our vertical spread that it suggests. And I'm going to modify the trade just to show it to you. And in this instance, 65 days is great because it's fitting your forecast. We want to, so far, if I'm going to give you my analysis on the marketplace is euphoric. And it's a nice euphoria in that there was an election. There's going to be a change in the administration. No policies are going to change. It's a lame duck Congress, presidency, everything that you want to talk about. So nothing's really going to happen. But everybody gets happy when there's change. So everybody's anticipating that things are going to be good. And that was my forecast prior to the election, and I still feel that way today. And we saw the SPX react, but there's really nothing going on no policy changes, nothing's going to happen. Okay, so want to get bullish on an underlying stock that usually does pretty well around the holidays. Amazon, hoping that the economy stays strong and they do very good with their sales. So we want to go out to January. We want to go out to the new year, make it through the holiday season. There you go. How we're going to do. If you just typed in Amazon, hit go, here is the bullish call spread that is recommended. Underlying stock is at 214. Last night when we did it, the stock was at 208, but the market is up 5 today. So it's suggesting buying a just in the money option contract and then selling the 235 strike. It's actually just adjusted it up 5 points from what it was last night. So if you click trade here, it will show you that here's the buy, here's the sell. If you can execute it at the midpoint, that's $9.75. This is the difference between the bid and the ask on the trade. This means this would cost you, for every 1-by-1 spread that you put on, $927 would be your max risk. And the difference between the strikes, which in this instance would be 235, this strike, minus 210, or 25 points, minus, one second, I gotta drink some water, minus the net debit paid, which is $9.27, the midpoint here, equals $15.73. That means our max reward is $1,573. So we're risking $927 if we can fill close to that midpoint, and our reward is this. We have 65 days to expiration. Now, highlighting the midpoint here on the trade inside the software, especially when we're just talking about generalities with trades, one of the things about entering a spread trade is you're coming to the floor and you're saying, I'm going to give you a buy and I'm going to give you a sell. In my mind, to use a little bit of the industry vernacular, that's a hedge. You're giving the market makers a position that it wants the market to go up. That's our buy of the call, and a position that is okay if the market goes down, and that's the sell of the call. And when you do that, a lot of times you will get better fills on your trades as opposed to just buying the option outright. And it kind of makes sense if you think of the world of a market maker that's down on the floor. They're always managing their risk on their trade. So a midpoint fill is a great fill, but if I'm entering this trade and I really want to get filled on it, and we're talking 927 by 937, I'm probably going to split the difference between the two here. My limit order at a net debit that I would send to the floor would probably be $9.32. And that's the way I would look at it. $9.32. And right from the platform, you can hit connect to first trade and you can send that trade to the trading floor at a net debit of $9.32. But usually when we're doing examples, we just work off of the mid because the midpoint fill is feasible when you're doing spreads. Pretty much straightforward. So this is the recommendation that came off the trade. This was the write-up that I personally did last night inside the daily play portfolio. And you can go back and look at the daily plays all through time. And you can see when we did the Amazon trade around the earnings, and that was 5 points wide, and it was just out of the money. Lower risk overall because it wasn't as wide, more of a speculative trade. And that's a fairly straightforward example. All right, I see some more Q&A. All right, I think we got. Oh, now all of a sudden the Q&A is working for me. I don't know why. It's popping up right where I want it to be. All right, so you have one last chance to answer any questions. And I see one pop up. What does speculative trade mean? Okay, that's a great question. I always assume that, and that's one of the things that you don't want to do as an instructor in the options world is make assumptions, especially when it comes to vernacular. Okay, so To me, I'll use the example that I've been using all day long because these are plays that actually have been recommended inside the options play platform. Is uh, speculative. If I have an earnings report, I am hoping that Amazon is going to announce earnings and that they're going to say good things in their conference call after the earnings report and the stock is going to go up. To me, that is speculative. I have 1 day to expiration. I use very short-term options when I put it together. And I'm hoping that I'm getting my forecast correct about what's going to happen on their earnings. I'm not going to risk as much. I'm not going to spend as much money because I'm totally just speculating on a very short-term trade on Amazon that is based off of that news announcement. Okay. Versus investing or using options as an alternative to buying the stock outright. That's the way that I'm approaching Amazon now. I might not, if I'm doing Amazon at this point in time, I'm okay with buying 100 shares of it if I can, right? If I have the capital to buy a $214 stock and most people want to buy 100 shares. If I have $21,400 and I want to get bullish on Apple, I don't think it's a bad time to do that. But this is an alternative. This is a way to be bullish on Amazon, a little bit more long term. This in the options trading world, 65 days isn't long term, right? But it's longer than 1 day or 1 week. So you got a fairly long-term trade, and we're setting this up because of the way that we're looking at the market, right? We're thinking going into the holidays, Amazon has had a strong quarter. They're not only in the retail space, their Amazon Web Services has been solid, had very solid numbers after their earnings report. They got some interesting things they're doing in the AI space as well. And because of that, we're going to ride this through this euphoric period before we get into the new administration. And so the rationale here is that we're going to do 65 days. But my rationale based off of that to me is more investing in Amazon as an alternative to owning the stock as opposed to speculating on what's going to happen after an earnings report. A lot more are popping up now. And Luis asked that, is there a preferred DTE for this strategy? Well, Luis, I'll tell you this. If I am doing what's the word? Okay. Is there a preferred? If I am looking at buying a long call debit spread, I am going to center it around my known event. Because here's one of the things. Here's the biggest thing about a debit spread, and this is going into a little bit more of the advanced side of things. But if you put the spread together, you are buying an option contract that wants the market to go up. And this is a 65-day option contract, and you're paying real money for it. $11.93 is what it's implying. These are real markets. And we are selling this one way out of the money and receiving $2.66. This needs to go away to make the maximum, right? So you want the market to come up to the strike, the 235, but we also need to, if we're going to close the position, we're going to be buying that back. So in particular on debit spreads, I want to think a lot about how far do I want to go out in time, knowing that if it does reach my strike price, this position is actually going to hurt me to close it. So I gave you the rationale on why I want to do the January 17th expiration and why I highlighted that inside the daily play position that we have on. So I'm just thinking about how you want to do this. Now, if I'm doing it because Amazon, which if you actually look at the chart, just had a breakout. So the breakout was right here at the 200 level, right? And I'm doing it just because it broke out. And I think that it's going to continue, and which, it kind of danced around here. Here's the breakout session. Then you got 1, 2, 3, 4, 5 days before it started to go back up again. if I'm doing it because it just broke out, I'm probably going to give it 2 weeks to play, right? I'm not going to go one day because it was earnings. I'm not going to go out 65 days because I want to get through the euphoric period caused by the election and the holiday sales season and all that other stuff. I'm doing it because we had a breakout to the upside. So I want to give it time to play out. And in this instance, it took at least 5 days. So if you bought it here where it broke out, it took 5 days before it really started to go again. So in that situation, I might do 14 to 21 days, right? So you got to pick your expiration because of the reason that I highlighted. You got to think a lot about the expiration you want to do on a debit spread. How do you hedge your risk? You already had, okay. So here's anonymous attendee. Could you have done a put spread on Amazon example if you expected Amazon to continue increase in stock price during the holidays? Maybe sell a put at around the current price and then perhaps buy. Okay, yes. Anonymous attendees said, could we do a put spread, put credit spread actually, I think is, there's a word missing in that. Could we sell a put credit spread around earnings, anticipating that it would go up? So yes, you could. So here, let's show you that. I'm just getting a little long-winded, so I was going to not get into the credit spread example of it. But if I want to get bullish on the trade, and I'm going to switch over to, let's just modify this one. All right. And here's what I would look to do if I wanted to sell basically in the same time period and bring in a net credit to the account. The market right now was at 214, if I remember right. And everybody's still seeing my screen, I assume. Okay, we're at 214. Okay, so yeah, you could almost come in this instance and you could grab the put and you could sell that one, and then we're going to buy this one and we're going to go further out of the money. We're going to sell a 210 strike, and that's about what I would go. That's about 5 points. Actually, maybe a little bit more. Let's see where we're at. I'd probably sell the 205. We could either go 205 or 200. I'm going to go with the 205 and then go down maybe 10 points. And let's see what that is, because we're going so far out in time, there's going to be a lot of premium here. And I am going to buy the 95. Okay. So here we're 10 points wide. We're bringing in about $2, right? $2.25. So we're risking 226, and our maximum loss could be $10, which is the width between the spread right here. So our maximum risk is $774 per 1-by-1 spread that you put on. This would be a way that I would flip the script and sell a put credit spread to be bullish, neutral to bullish, right? The market can now come down to the 205 strike before I start getting in trouble. So if the market just stays where it's at, well, I'm okay. And if it drips higher and it goes higher, I'm even better. But if it does come down to 205, well, then now I'm at risk that the stock could be put to me at 205. I have the right to take the stock at 195, but I would have to sell it, or I would have to sell it at 195. I have the right. They have the right to put the stock to me at 205. That means I could lose $10 on that trade. That's how I would set up the short put credit spread as an alternative. All right. Well, I definitely went long on this scenario, and I think that's going to be it for options play education here on the First Trade platform. I want to thank First Trade for letting us be the host of this event today. We'll be back in the short term to talk more and more about all these option strategies, and we'll even get a little bit more advanced as we go along. But we'll be doing something. Somebody was asking about implied volatility and risk. I'll make sure to do something on option pricing here shortly also, so that you can that we can answer that question about calculating implied volatility. And I see no more questions, so that's going to be it. My name is Brian Overby. I am the senior options strategist at Options Play. If you'd like to follow along with what I'm doing, please check me out. And my Twitter or my X handle, x.com, is at my name, at Brian Overby. And that's going to be it for today's event. Thanks for coming, everyone.